Now, the markets were unfazed by escalating hostility in Washington and, of course, that violence in Syria. All three indices are rallying at this moment. The Dow is now up about 240 points. This, despite evidence that Fed policymakers were more worried about the economy when they held their September meeting. Mona Mahajan is a U.S. investment strategist at Allianz Global Investors. She joins me now. I don't think you seem too surprised about this. Explain why.
Well, from the Fed perspective,
Yep.
we've been saying there's three key messages Jerome Powell has been giving to the markets. One, he wants to extend this expansion for as long as he possibly can in the U.S. Number two, he is worried about what's happening globally, uncertainty around trade, what's happening in China and Europe in a slowdown perspective. And then number three, he really does think about this as a mid-cycle adjustment or an insurance rate cutting cycle. So in the past, when you look at the examples from the late 90s, that's typically been 3 rate cuts, 25 basis points each. We've gotten 2 rate cuts thus far. We do think 1 or 2 more are likely, but then it will be very data dependent after that.
And data dependent why? Because some people say, look, they're going to be running out of ammo at that point in time. You've got to halt somewhere.
Yes, I think the concerns about what's happening globally and what's happening in the U.S. around manufacturing are the reasons that you do have to take out this insurance. Now, the services sector and the consumer in the U.S. have been strong. We saw that in the jobs report just last Friday. We've been seeing that in some of the non-manufacturing data that's come through, including retail sales and consumer confidence. So not yet a full rate cutting cycle where we're going anywhere near, a zero or an even negative bound like we've been seeing globally. But I think 3 to 4 rate cuts do make sense just to protect the U.S.
Help us make sense of what has been a very impulsive market, especially when it comes to trade. At this time yesterday, viewers were here. We were going down on China headlines. Today, we're going up on China headlines. How do you make sense of that? This is a real twitchy market.
Yeah, I think the trade headlines have been a driver of the market, although I think the uncertainties more broadly are also what's been causing this volatility that we've been seeing. On trade specifically, our base case is that we don't see the two sides coming together for a comprehensive deal. We're not going to address IP theft, technology transfer practices, et cetera. Could we get a more what they call skinny deal with, soybean purchases going up and maybe some tariffs being pushed out? Potentially, yes. What we're watching are 2 key dates. October 15th, the next tranche of tariffs goes into place, and more importantly, December 15th. That's when that last tranche goes into place, really affects consumer goods, areas like apparel, footwear, toys. That's really where, if we are going to get any upside, if those tariffs get pushed out, we could see some positive.
Yeah, and those are the days that corporate CFOs worry about, right? Because in terms of any projections, it's going to throw them off. Let's talk about the investor. Investors who've been cautious have been punished out of this volatility. Really, they have been. Every time you've seen any pullback, you come right back up. What's your advice in terms of a posture to take here?
Yeah, it's interesting. So the S&P is up about 15, 16% year to date. When you look under the hood, there really has been some sector rotation there that's driving that. There's been this rotation over the last quarter into defensive sectors, and that's really an area that we're focused on as well. So on equities, that means areas like consumer staples, REITs, utilities, even parts of healthcare that have lagged. I think it's important to build a strong defensive portfolio given the uncertainty that we're seeing. On the other hand, in what we call a barbell approach, the long-term stories around technology remain interesting to us. So there are disruptive technologies emerging, areas like cybersecurity, like cloud computing, like even mobile payments. They have long-term legs in a low-rate environment, can do well. And so we think investors particularly are well positioned to take that barbell approach.
Gosh, it sounds optimistic, doesn't it? Some people are telling me that even the concept of a flash crash is absolutely gone. I have to go, but I want to get your perspective on that.
I think October is notorious for those flash crashes. So if we get one, we could see it in the next couple of weeks. But I do think December is also historically pretty positive in the market. So get through the next few weeks, a lot of data, the Fed's in play again, and then we can see from there if we get some more positives.
Thanks so much. A lot of good information.
Thank you. Great.
Appreciate it.